Joining us now is Warren Pies from 314 Research and David Bahnsen from the Bahnsen Group. Guys, welcome. Warren, so first time we've had a Monday down 1% plus on the S&P 500 in more than a year. What kind of action do you see, particularly in the relationship between stocks and fixed income?
Yeah, thank you for having me. This has been really, we go back to the second half of last year. There was a tight relationship between stocks and yields. And essentially when stocks and bonds were tied at the hip until we entered 2024. And we've had this kind of divergence between the two. Everyone's been watching and wondering how high can yields get before it impacts the stock market. And I think we're starting to find out that you get above 4.5% and it becomes a headwind for the markets, you know, from a valuation perspective, relative and absolute, and from a business fundamental standpoint. We're getting to that area where it starts to impact stocks, and we're seeing that, the indigestion in the stock market.
And David, you got your eye on dividend payers and energy stocks, given these geopolitical tensions we're seeing?
Yeah, I mean, yeah, very much so. And I think that the reality today was that the market was up 300 points with bond yields up big, and then it went down over 200 points with yields still up, which really indicates an intraday volatility that is far more likely related to the geopolitical tensions. We very much believe dividend growth, because of its embedded focus on quality, value, different types of balance sheets, different types of debt ratios that kind of speak to higher quality companies. And then, as you mentioned, the energy side, we have some great dividend growth names that happen to be in the energy sector, therefore perhaps correlated to some of the geopolitical tensions in a positive way.
Yeah, Warren, I do want to go back to Treasury yields here for a moment, because the fact that we have seen the Treasury complex continue to sell off, despite the fact that you have seen this investor shift to safe haven as volatility has moved higher, risk assets have taken a breather here. What does that tell us, and what does that signal about what is driving the narrative right now, given the fact that there are so many macro and micro dynamics to factor in? What is actually moving the bond market right now, and why?
Well, I think you have two big things. Number one, you have, this is the obvious one, is the Fed is probably not going to cut as soon as everyone expected, even a few weeks ago. So that's number one. But I think the big picture reason, the big picture mover for the bond market is the creeping realization across the market that the terminal rate for the Fed, which means where are they going to end when everything's said and done with their cut cycle? Where will those rates bottom out? For years, the Fed has said 2.5%, and with the last SEP, they just nudged that number up to 2.6%. I think that the number is actually significantly higher than that, and the economy has changed in a significant way coming out of COVID with the excessive amount of debt and fiscal spending, pro-cyclical deficits. So to me, that's the big thing. And then when you say, okay, where are rates going to end this cycle, there's a certain appropriate spread for where the 10-year should be, and I just don't think we're really there yet. And that's what the bond market is starting to kind of digest in real time.
David, I wonder how you see it, especially where the Fed is concerned, because the way I see it, it's essentially like a Venn diagram. You have geopolitics, you have inflation, you have the Fed sort of sitting in the middle, because we know geopolitics, A, breeds uncertainty, and B, historically can be very inflationary. Look no further than industrial metals, aluminum and nickel today, also tied to geopolitical dynamics, specifically more sanctions on Russia and trading of those metals as they come out of Russia. How does this now potentially factor in when we do see these rising risks in the Middle East and elsewhere? How does this factor into the Fed's calculus and thus impact to the market? Can we even possibly begin to game that out yet?
No, you cannot. And the reason why is that there are so many moving parts. It's incalculable. And we're also talking about the difference between the optics of what the Fed does and the underlying decision making. Those things involving commodity prices that are not related to monetary policy, that are extrinsic in some of their supply demand factors, as well as, just as you said, geopolitical heat. The Fed funds rate doesn't affect Middle East geopolitical, weekend tensions. These things are somewhat permanent circumstances. And so I think the Fed is primarily focused deep down in places they can't talk about at parties, on the fact that there's a maturity wall of debt coming in commercial real estate, corporate debt. They've gotten a huge free ride for a couple of years. High rates that nobody's really actually paying. And I think that ultimately the inflation data will show what it's going to show, but the Fed cannot let those moments happen. Where I would somewhat disagree with my colleague here on air is I think that the terminal rate of Fed funds is never going to go back to the zero bound, which he's agreeing with, but I don't think they can let it go higher because the Fed ultimately is in an accord with the Treasury Department that the federal government cannot afford the debt that's been put on. And this new level of debt and growing deficits was not new after COVID. It had been going on for 15 years before COVID with declining rate environment. Ultimately, the Fed is trying to manage a bunch of things at once that it really can't do other than praying it gets lucky.